Hey everyone, this is OnDeck's daily chart. OnDeck is a recent IPO in the peer-to-peer lending business. They have really strong growth numbers, and they are not profitable yet, but I think they're going to get profitable pretty shortly. And when it does, I think the stock will really take off. They are a disruptive business, so you want to keep an eye on stocks that are disruptive to business or consumer habits. These tend to really explode in a year or two. What we have here on the pattern is something I observed called the $1,000,000 Chopsticks Pattern. And I came upon this pattern after looking at over thousands of charts, literally, to try and understand when stock reversed. And so this is the pattern that I came up with, and I would like to explain it in excruciating detail so that you'll understand when to get in, where your stops are, and stuff like that. So first of all, you want to look for a stock that is in a mild downtrend. You don't want a stock that gaps down 20% or one that's just really volatile. You want a high quality stock that is pulling back, hopefully in the 15 to 25% range, and especially have it move along the 10-day line. So in this case, OnDeck is an IPO, so you'll get a lot of volatility up front, just because people are unloading shares and there's a lot of hype in the stock. But as you see down here, the pullback gets more gradual and it stays along the 10-day line. So once you find a stock with this kind of a downtrend, you want to go ahead and draw the downtrend line on the chart. And the first signal you want to see is a cross of the downtrend line, the price to cross above the downtrend line. And that would also, at the same time, or around the same time, be a cross of the 10-day line. So this double signal would kind of, provide you with a better signal. A crossing of the 10-day line is also the breakout of the downtrend line. Now, for an aggressive trader who wants to get in early, this would be the entry day to get into the stock. The advantage of getting in early is that you can keep your stop as close as possible to the swing low and reduce your risk. So here, this candle would be this low. So your stop would be a little bit below that low, just to give it some room to run. And the risk of going in early is that the pattern might fail early on. But this is one entry point. Now, after it breaks above this downtrend line, what you want to see and wait for is the stock to go ahead, make a move, and create a high. This candle here will be a high or swing high. And after a swing high, you want to see the stock pull back and make, very important here, is try to make a higher low. And in this particular case, we have a candlestick pattern called the morning doji star, which is a reversal pattern. And when you make the swing low, in this particular case, you do see increasing volume, and that's a good sign that you're getting buyers in here. Now, if you're really good, with candlesticks, you may have gone in early here, keeping in mind that this would be your stop, and that would be your risk. So if you're really good with candlesticks and see reversal signals here, you might want to do an entry here, but that's not a quote-unquote official entry. And then the next thing you want to see is the stock to continue head back up and start to make a new high, which would technically be at this price. But when I'm looking at this chart, I really see resistance at this level right here. So I would put the buy point at this resistance level. So if it breaks above this resistance level, it's pretty much it's going to make a new high. There's no guarantees obviously in the market, but the assumption is if you can get past this resistance level, you can go ahead and continue up. So a safer bet is to wait until you break above this resistance level for the second time and go ahead and buy. And it's safer because you have a low, a high, a higher low, and then the potential for a higher high. And that is a definition of a trend change. So that's why this pattern works really well. Now it's not to say that price can't consolidate here for a while, but in a strong moving stock, you're going to have a quick high, a pullback, and then a burst out above into a breakout. And from here, it can move anywhere from 20 to 50%. It all just depends. But when I look at the price target, I just kind of look at where resistance is, and you can expect it to move at least to that resistance and test it out. So in this particular case, the resistance would be at 24.52-ish, and that would be a profit of about 22% from this breakout line. When you buy at this breakout line, you can set your stop at this swing low or at this swing low. If you want to be safe and conservative, you can go ahead and put your stop here. If you want to be more aggressive, give it more room to run, you'll stick with this original stop here. Once this thing breaks out, you might want to raise your stops to below this line, because once it breaks out, it should not go back and make this retest this line. What you might want to do is wait for it to go up, make another swing low, head up, and then raise your stop to that swing low stop. That'll protect your profits and at the same time allow the stock to run as far as possible. Once you get a winner, you want to hold on as long as possible for maximum profit. But when you have a loser, you want to cut it as fast as you can and minimize your loss. That's the only way to be successful in the market. If you hold on to a loser and let yourself lose 40-50%, you'll have to make 100% gain just to break even. And that's really difficult to do even for the most experienced trader. So that's pretty much it. That's the chopsticks pattern. You'll see it in all kinds of stocks, and it works really well. Wait for a pullback in the market, 10 to 15%, and start hunting for this pattern, and you'll profit from it. So that's it.